When it comes to investing in the stock market, understanding the balance between risk and reward is crucial. Every investment carries a degree of risk, but the potential for reward can make it worth taking. The key to successful investing is knowing how to assess and manage these risks to make informed decisions. This involves evaluating the likelihood of both gains and losses, as well as considering your financial goals and risk tolerance. Risk in stock investing refers to the possibility that you could lose money. However, it's essential to remember that risk isn't inherently bad. In fact, without risk, there would be little opportunity for substantial rewards. The trick is understanding how to evaluate and mitigate risk so that you can make smarter decisions about where to allocate your capital. To assess the risk of a stock, start by examining its historical performance. While past performance doesn't guarantee future results, it can provide valuable insights. Stocks that have experienced significant volatility, large price swings, may carry higher risks, but they can also offer higher rewards if managed properly. Conversely, more stable stocks may be less volatile, but they often come with lower returns. Understanding how a stock has moved in the past can give you an idea of how it might behave in the future. Another critical factor in evaluating risk is the company's financial health. A company with a solid balance sheet, manageable debt, and positive cash flow is likely to be more resilient in times of economic downturns. Companies with weak financials may be more vulnerable to market fluctuations, increasing the risk of a poor investment. By reviewing financial statements, including income statements, balance sheets, and cash flow reports, you can gain insight into the company's ability to weather both good and bad times. The industry in which a company operates also plays a role in assessing risk. Some industries, such as technology or biotech, are inherently riskier due to their reliance on innovation and their sensitivity to economic changes. These sectors can experience rapid growth, but they may also face regulatory hurdles, competition, or unforeseen events that can negatively impact stock prices. On the other hand, industries like utilities or consumer staples tend to be more stable, with predictable demand and less volatility. Market conditions and macroeconomic factors are also essential when evaluating stock risk. Interest rates, inflation, and economic growth all affect the broader market individual stocks. For example, in a high interest rate environment, borrowing costs for companies increase, which can lower profits and stock prices. Similarly, during periods of inflation, consumers may cut back on spending, affecting the earnings of businesses. Understanding these external factors can help you assess the overall risk of your investments. A company's management and leadership are key factors in determining how well it can navigate risks. Effective leaders who have demonstrated the ability to adapt to changing market conditions and innovate can reduce the risk associated with an investment. In contrast, companies with poor management or a lack of strategic direction are at higher risk of underperforming, regardless of external conditions. One common way to measure risk is through the concept of volatility. Volatility refers to the extent to which a stock's price fluctuates over time. Stocks with high volatility may experience significant swings in price, which can be unsettling for investors. However, these price fluctuations also create opportunities for greater rewards if timed correctly. Conversely, low volatility stocks tend to be more stable with smaller price movements, which may be appealing for risk-averse investors. Another method for assessing risk is to look at the stock's beta. Beta measures a stock's sensitivity to market movements. A stock with a beta of 1 moves in line with the broader market, while a stock with a beta greater than 1 is more volatile than the market, and a beta less than 1 indicates the stock is less volatile. By understanding the beta of a stock, you can assess how much risk the stock carries in relation to the overall market. It's also important to consider your personal risk tolerance. Every investor has a different capacity for dealing with risk. Some people are comfortable with the idea of losing a portion of their investment in exchange for the potential for high returns, while others may prefer safer, more predictable investments. Assessing your risk tolerance involves understanding your financial goals, timeline, and emotional ability to handle the ups and downs of the market. If you're investing for the long term, you may be able to weather short-term volatility for the sake of greater long-term rewards. In addition, diversification is one of the most effective strategies for managing risk. By spreading your investments across different stocks, sectors, and asset classes, you reduce the likelihood that one poor-performing investment will significantly impact your overall portfolio. Even though diversification doesn't eliminate risk entirely, it helps balance the potential for loss by lowering exposure to any single risk factor. Finally, remember that risk and reward go hand in hand. The higher the risk, the greater the potential for reward. However, that doesn't mean that taking on excessive risk is always the best strategy. The goal is to find a balance that aligns with your financial objectives and risk tolerance. By carefully evaluating a stock's historical performance, financial health, industry, market conditions, management, and volatility, you can make informed decisions that optimize both the risk and the potential for reward in your investments.